Hello to my Big Trend subscribers. This is Price Headley with your Big Trends Earnings Extravaganza product review. Every quarter we get into lots of opportunities where earnings are being reported, and the question is, how are you taking advantage of it? Are you taking advantage of it? This will show you how you can as we focus you on my favorite strategy to jump on earnings-based trades. Just a reminder, everything I share with you here is not for any specific recommendation of any investment, but rather to just inform and educate you on how you can position yourself if it suits your own particular trading risk tolerance. Ultimately, of course, you know that you are solely responsible for your own investment decisions. Big Trends and the staff are not responsible for any trades you choose to make. We don't provide personalized financial, tax, or legal advice at Big Trends. What we do is we take these earnings-based research that we do, and we actually convert it into trade ideas that you can then decide how you want to implement them at your own discretion. Just a reminder, what I'm going to share with you today is how we take advantage of earnings volatility. Now, volatility is a word that scares a lot of people, but I think that the earnings approach that we've used has proven itself to give a nice edge over time, knowing that any one trade can be right or wrong. It's about how you get more out of your best ideas and how you control your risk. We're going to talk about both of those here in this product review. And get ready in front of every earnings season. Now, why should you be interested? Well, looking back at our last earnings cycle in the third quarter reports that came out from the second week of October into early November, you can see that this is over 22 trades. Assuming that we put in no more than $1,000 a trade maximum on any options recommendation. Even if that meant you only got one contract, you said, fine, get that even one contract exposure, because we never recommend an option over $10. So you can always get at least one contract for $1,000 or less. And that means over that 22 trades, you'd have generated $1,617 in gross profit dollars. That adds up all the winners and losers before commissions. This is a simple strategy. We're just buying an option when it's time to get into a bull or bear play. We buy a call on a bull side, we buy a put on a bear side, and then we also, of course, give you the targets and the stops to manage the trade every time, so you're never left hanging. So you can see, that's something that you can get a pretty nice bang for your buck over a month's concentrated time, and this happens 4 times a year because the end of the quarters happen, end of December happens, and then you see in January into early February, you start seeing a lot of those S&P 500 companies reporting their earnings for that fourth quarter in that next month or so. Same things, first quarter ends April, you see that start rolling into early May, then July into early August, October into early November. So with that earnings comes volatility. A lot of people get scared by that. I think the key is, how do you manage that volatility to make it work for you? You need to trade only when you have the strong odds of winning in your favor. If we don't have that, we stay away from a lot of trades. We pass on because they don't fit the profile I'm going to share with you here today. So the question would be, okay, do you like to buy the trend, or do you like to sell options premium in front of earnings? What I'm going to focus you on is how you want to watch the stock's behavior in front of earnings, but then get ready to take advantage of a potential gap that's coming because of the institutional buy or sell pressure that's happening in front of the news. Here's a case with TripAdvisor from early November where we saw TRIP as a symbol. The stock had already been strong. And the couple of indicators that we tend to focus on are the percent R here, this red line here, Larry Williams percent range indicator. I use it in a different way to actually say, you know what, I want it to go overbought. And when it goes overbought, I want to see it keep going up. So when it's going overbought here, it keeps going up, closes above that, what should be the top of the range. It tells you it's not the top of the range anymore, right? It's the start of a potentially new uptrend because the institutions keep on buying. Let's face it, the institutions drive the market more than me or you as individuals. The CCI, which is the blue line down on this bottom panel, that's the commodity channel index. It works really well on trending stocks too. So you see the CCI is starting to break out about the same time as percent R, and it too is falling through a few days before the earnings. Why don't we buy it when the signal happens rather than the day before earnings? So on the circles where we actually bought into the trip calls, we bought the 51.5 strike calls per our recommendation when the stock had closed near the end of the day around $58. If you're new to options, if you have a right to buy a stock at your strike price of 51.5, the call gives you the right to buy. And at 51.5, it's already at 58. That's worth $6.5 or $650 a contract. We're paying $800 a contract. quoted as $8, but it controls one contract controls 100 shares of stock. So for $800, you're controlling a stock that would usually cost you for 100 shares about $5,800. So that's where your leverage kicks in, about 7-to-1 in this example, where it goes from 58 next day to about 65, 66. So you can see we're up in the neighborhood of about maybe 13%, and we're making 100% on that option trade because we bought it at 8, we're selling it out at 16. Anytime I can get a double on these earnings trades, or better in some cases, I'll say take the money and run. Our best trade was on Netflix, up some 250%. That's not to be expected. Usually it'll hit a double, we take it. If it keeps on going, fine. You can see in this case, it gave it back. It ended up filling that gap. Some people say all gaps eventually get filled, but that's something we're not hanging around for that. We actually want to get our double typically that very next trading day. The sooner the better. If we don't get it quickly, we will actually start adjusting your upside target and tell you via real-time trade alert through email and text message to your smartphone that you need to adjust your target if we don't get that first 100% quickly after the earnings. So as a subscriber, you learn all those specifics about when to adjust your target, etc. What about a downside example or two? You look here at Southwest Airlines, ticker LOVE, one of my favorite symbols, LUV. You can see the stock was already breaking down here below a prior key low around 57. But what we're looking at is that you're getting both the CCI and the percent R saying that that low is a key low to watch. If that bottom of the range does not hold, which you see in that late bit of trade in that very sharp red downside candle, red candle means that we're closing down way below where we open, that's a big time breakdown that's confirmed as a downside trade. This is happening the day in front of earnings. So guess what? Do you think that maybe sometimes the institutions might know more than you or me about something that might be coming up in the near term? I always assume that they do, and my job is just to read the price action to tell me when it's a strong enough breakout or breakdown that you can profit from as an earnings extravaganza trade. So you look at this and you say, okay, the 60 puts, now think about this too. We're talking about option selection for a second. We're closing on LOVE shares down here around $55. Well, a 60 put means you have a right to sell LOVE at 60 now, the LOVE shares at 60. It's at 55. That's worth $5. 5 of that 531 is intrinsic value. You're only paying an extra roughly 6% over and above the intrinsic value on the time portion of the trade. And it's only the time portion of the trade that gets affected by the big volatility jumps that can happen right in front of earnings. So by creating more of what we call a stock substitute or stock surrogate approach here, we're able to get tremendous leverage. Again, instead of it paying for something that's at $55 a share, we're paying just over $5. So that's like almost 11-to-1, certainly over 10-to-1 leverage. So when the stock drops from 55 down to 50, or just under 50, you can see we're down just about 10%, and we're getting right around 100%, 99.6% to be exact, out of 1060 versus our 531 average entry price. This is something you can automatically trade through select options auto brokers that work with Big Trends and Big Trend subscribers as well. Once you become a paid subscriber, you can take advantage of that. Feel free to call our 800 Big Trends line for more information about auto trading so you don't miss out on these trades. We're out that next day, and then whatever happens from there happens, but we'll take that near double, right around the double and run. Here, just over a double, 100.2%, average those out on Caterpillar puts. And this is a classic case, too, where you see not only is Caterpillar broken down, but broken down strongly below the last support at 140. Both the percent R was setting up for a break when it closed under 140 there, so the percent R is bearish. And CCI, interestingly enough, is already bearish from earlier on that blue line on the oversold threshold. So what you'll notice is that oversold, the bottom 20% on percent R, oversold on the CCI in that oversold range. That will tend to last longer than you or I would expect, but more importantly, that's where you see your best directional trends. In this case, the near vertical trend down in CAT. So CAT was a dog through this phase. Bottom line is that it closed that day around 130, maybe even 129. We'll call it 130 for a round number. If you bought a 137 put, that's in the money by 7 points. We're paying $9.09, so about $2 or $2.10 of that is what we call time premium. So in this case, that's roughly maybe 25% at most. That's time risk. That means if nothing happens, it stays flat here from where we got in. You could be losing that time portion of the trade. Obviously, you have price risk if it goes against you. We'll show you an example where we got stopped out next. The idea here is that when we're focused on, okay, does CAT get there in the next day? Not off the open, but actually a little bit later on that pop down intra-bar there. We're taking it out when the stock's down here to about 117. It was just at 129 or 130. So that's about a 10% drop in CAT the next day, good for 100% in our put option. So about a 10-to-1 leverage in that case. So, again, it's not about getting maximum leverage. It's about trading the right kind of option so that if it doesn't move, you've controlled your risk first, and then you can still get that kind of a doubler in your portfolio. What if it doesn't work? Here's a case of one that did not work on a retest. A retest is where we've been in a bear trend, and now we're getting into a cross back up where it's a critical time for that definition of that trend. Both these gave what we call a double retest right off of this high, saying that high should hold. This was 2 days before earnings. The next day, we got into the puts on Chevron, CVX, again, when the stock was trading here in the neighborhood of, you can see about, call it 112, about 5 points in the money. We paid a little more on this one because there may have been an earnings report to come. Well, and there was as we were trading here. Is it the earnings report to come made that a little bit pricier on this option, and so $5 we're paying about $2.90 intrinsic. That's probably about the maximum. 3 out of $8. That's about just over a third that we're paying in time value. Usually we like to keep these about 2/3 intrinsic, about 1/3 time. This retest should have held. You see the next day it gaps up. We're getting stopped out there soon after the open, down 51.25%. We keep our stops around 50%, but you can get some slippage past there. Or if the gap's really violent against us, you could lose what you put into a trade. Let's face it, or you could lose the bulk of it on one trade. The way to manage that, if that scares you, is don't overcommit your capital on any one trade. We recommend no more than 10% of your capital you allocate to trading the Big Trends Earnings Extravaganza going in to any new recommendation. So with that understood, there's going to be losing trades, but you just have to know how to manage that. Another retest, you say, well, that retest thing, maybe that doesn't work so well. Well, it can be an absolute champ like it was on IBM here. IBM had already been in the bear confirmed mode here. You can see as it broke down below all that support, and then it came back up for what we call that retest the day before earnings. We're saying that high right there around 145 should hold, and we're closing right near it. We're saying, look, we think this is a great low-risk entry point in a bear trend. The next day it opens and trades right down to 135 very quickly. That 10-point drop was good for the 150 puts, going from that 830 investment initially up to 1660 and making us 100% gain the very next morning. So this is the kind of thing that can really help you to get aware of when the trend structure is favoring a big move, or if it's not favoring the move, then you should stay away, because you need to get plenty of volatility on the gap, plenty of big directional movement, and that is usually clued in by the fact that you're already seeing the institutional buying and selling pressure overall in the days leading up to the earnings. Now, how do you get what do you take advantage of from our Big Trends Earnings Extravaganza? We take our research, we convert it into real-time trade alerts. We call it read it to your broker instructions, but you can actually have select brokers auto trade it for you. We were saying buy to open the TripAdvisor November 51.5 calls with the set price. And so you get that kind of clarity, as do the auto brokers, so they can get you in and out quickly and easily, and you can get out quickly and easily, and it's time to go. You know what your stop and your target is. And then I give you a regular video training teaching you about what I'm looking at, updates through email and text as well, just to make sure you're never left hanging and you're always learning while you're earning. So, just as a general principle, if we could quarter to quarter do something in this neighborhood, which there's no guarantees we can. Some quarters are going to be up, some quarters are going to be down. But we're very confident that we've got much more upside potential relative to our risk, taking advantage of the leverage of options and saying, okay, in this case, we did about $1,600 and change for 22 trades, some winners, some losers, before commissions, putting in no more than $1,000 a trade. Past performance won't guarantee future results, but we think certainly that we have something that you want to take advantage of in the form of the Big Trends Earnings Extravaganza service. So make sure to take advantage of the special you see on this Big Trends Earnings Extravaganza page. If you have questions along the way, feel free to call us toll free at our 800 Big Trends number, or drop us an email anytime over to clientcare@bigtrends.com. I look forward to you joining us on the Earnings Extravaganza and helping you take advantage of more big earnings moves ahead. Trade well.